the Treasury Bills market traded on a bearish note as offers continue to dominate the market. Traders at Axis Bank say they expect a quiet market today as players continue to trade cautiously. Now, Kinskin Ukeje, Treasury Team Member at Axis Bank, joins me now for more market updates. Kinskin, thank you so much for joining us on the show today. Now, this is our first interaction really in the second half of the year. Take us through what's playing now from the perspective of the liquidity base. We saw what played out last month, how liquid the system was, and where investors are positioning. It's early days, but what are the intricacies at play?
Oh, thank you for having me. For the liquidity, we've seen it at elevated levels closing last month and into this week. Starting in the week, we saw in liquidity enter the week as high as 788 billion starting on Monday, and yesterday also we've seen it at 751 billion opening yesterday, and we've seen also the OPR and overnight rates trade at 1.14% and 1.57% respectively on those ends.
And your outlook for this month and the rest of the second half of this year?
Unless we have a monetary policy through like the CRL coming to take up such liquidities, we should see a sustained liquidity level at these optimum levels going into the near weeks.
Okay, now, one of the interesting elements we've also seen in reports from the Bank of America is the fact that we're seeing the bonds here, the Nigerian bonds, outperforming their peers, and also for the fact that we are expecting to see, from their own perspective, about 700 basis rate hike within this year, and also looking at inflation about 30%. How concerned do you think investors are really from this feelers, this report from the Bank of America?
Yeah, from the report of the Bank of America, I would not fail to agree on the inflation hikes, which we should be seeing. Already we've been seeing the growing food inflation have this impact on our inflation numbers. Then once you catalyze it with the fuel subsidy removal, we should see that impact also shoot up the inflation numbers to above 25% as in their report. For the 700 basis points hikes in our bond yields, we would only see that if there's a policy shift. That's the only way we could see that hit that market. However, you could see the policy shift in the FX market during the liberalization, causing the rates to go up from 400 to 700 levels. So only such policy shifts can cause that 700 basis point. However, if the investors just expect markets to just trade up to those levels, I don't see that happen, because even in the recent years we've seen the market trade mainly on technicalities rather than fundamentals. What you would see is that so far as banks have idle funds to apply and make their profits, they will continue to play in the fixed income space.
Let's also talk about the leanings across the curves from the T-bills market and then to the bond side of things. Now we're seeing the 2053 catch the interest of investors.
Sorry, I didn't get you.
Talking about leanings, buy interest and sell, buy interest across the curve. How are investors leaning?
Yeah, we continue to see appetite on the long end of the bond side, and also on the T-bills we also see that appetite on the long end. For the bond end, we are seeing the 53 is currently trading at 14.77 levels, and we've seen profit taking from the last bond auction that was held up to these levels.